From the outside, the process of syndication can seem kind of complex and pretty daunting, right? There's a lot of moving pieces, a lot of different parties involved. So what I thought I would do is create a video on the exact process of what happens behind the scene of a multifamily syndication. So whether you're an active investor or passive investor, you'll get to see exactly what goes on behind the scene, what each party needs to do, so that if you're involved in these, you have a very clear roadmap. What's going on, guys? My name is Lior and welcome back to my channel. Now, if you don't know me, I'm a multifamily investor and syndicator here in Boston. And before we get into the meat and potatoes of the video, super quickly, guys, if this is your first time on my channel, make sure you smash that subscribe button for me. Putting out daily content on this channel, talking all about multifamily investing and syndication, running a business in the space, tips and strategies, and everything in between. So if that's the kind of content you're looking for, make sure you subscribe. So let's get right into it and talk about this process, this behind the scenes process of what goes on in a syndication. So typically what happens is first there are, the operators or the syndicators, and then of course the limited partners or the capital partners, right? And basically, usually first, there is some sort of a pre-existing relationship that needs to be established, right? Because, regardless of a deal, if you're gonna be an active investor, right, and you're gonna raise money, you're not just gonna go to someone that you've never met before, had no interaction with, no relationship with, and just raise a bunch of money, right? It just doesn't really happen. People wanna work with and do business with people that they like, trust, and respect, right? So typically there's some sort of pre-existing relationship where you talk with the investors, you talk with your limited partners, and a relationship is built. Now, when a sponsor then actually puts a deal under contract, things actually get rolling, right? So first, what happens is the sponsor puts a deal under contract, and then they have their due diligence period, right? And during that due diligence period, the sponsor will do due diligence on everything about the property, and this can include things like inspections, environmental reports, talk to the city about any sort of renovation plans, anything like that, right? Review financials and leases, right? So there's a lot that goes into it. But at this point, it's really up to the sponsor to perform the due diligence and make sure that the deal is clean, still looks good, and all the underwriting projections that they put together are still in place and that they still feel confident behind them. Now, if assuming all goes well and the sponsor goes by due diligence, then typically what will happen is the sponsor will sign, a sales contract, purchase and sales contract, however you want to call it, and then wire over an escrow deposit, right? In very competitive markets, right, like where I'm at in Boston and all across the country, if it's a very competitive market and a competitive asset class, the sponsor's probably going to have to go hard on their escrow, right? Which means it's non-refundable. That means they have to close on the deal. And then once the sponsor does that, they're gonna start to work on their marketing package, right? And the marketing package is essentially gonna go over all the details of, the property, right? And the project. So it's gonna go over the sponsor's plans, the financials, what he thinks he can do, where the value is gonna be extracted, what the business plan is behind that, the team that's gonna be helping him operate this, right? So basically creating a full marketing package to really explain exactly what's going on, so that when he or she talks to potential, limited partners or capital investors, they have an exact understanding of what's going on with this deal. Now, during this phase, this is a pretty stressful phase for a sponsor. I've been there a lot myself, obviously. But basically what you're doing is having a lot of conversations, whether it's phone conversations, Zoom conversations, email conversations. You're answering a lot of questions, concerns, strategies, thoughts, that are coming from your limited partners, right? Because obviously there's going to be a lot of questions and people want to make sure they really understand the strategy. They want to make sure they understand the full risk spectrum, the full reward spectrum, right? So that they can make the best educated decision for themselves, which of course makes sense, right? So, the sponsor is going to be answering all these questions, making sure everyone feels comfortable, talking all about the business plan, and really trying to get everyone as comfortable as possible with the business plan that he or she has put together. Once that happens, the sponsor will usually ask for what's called a soft commitment, right? So this is usually a verbal commitment. This is not like something that a limited partner or capital partner signs on. But basically, after answering a bunch of questions, right, and assuming the capital partner or limited partner is still interested in the deal, the sponsor will say, hey, something along the line like, hey, are you interested in potentially moving forward with this, right? And if so, how much, right? And typically a limited partner will say, yeah, you can sign me up for 50,000, 100,000, 200,000, right? Whatever the amount is, that limited partner is going to tell the sponsor. Now, this is not a binding commitment yet, right? So this is something that's soft and verbal. So as a sponsor, it's really critical, to, of course, get as many commitments as possible and ideally even try to oversubscribe, right? I mean, that's the absolute ideal scenario because, things happen, right? I mean, someone could tell you one week they're committing $100,000, something happens to them, and the next week, all of a sudden, they can't invest that $100,000, right? And that's happened, right? And there's nothing, there's no good or bad. It's just, it is what it is. It's part, it's part of the probability. So what that means for the sponsors, again, ideally you oversubscribe, you have, you have more commitments than you need because you're probably going to assume that some of them are going to fall through. Then once that is all set, now comes a little bit more heavy work, which is creating the PPM, right? Or the offering memorandum. And this is a really thick package, usually created by an attorney or something along those lines. And this will have all the information about the deal, all the financials, the strategies, the fees. It's just going to outlay absolutely everything there is to know about the deal, as well as typically there's going to be an operating agreement, right? And that is what the limited partners or the capital partners are going to review as they do kind of one final review, right? They're going to look through everything, make sure it all looks good. And assuming that all looks good, the investors are going to sign the docs and then wire over the funds to the operating account of the LLC that's going to be buying the property. So, that's kind of the process in a nutshell of how it works, right? There's a lot of kind of steps in the background going on. That are both performed by the sponsor or the syndicator and of course the capital investors. But hopefully that helps, guys. So whether you're an active investor or passive investor, hopefully this kind of sheds light into what goes on behind the scenes. Of course, if you guys have any questions about any of this process, make sure to put them in the comments below and I will definitely help you out.